Welcome to another episode of Axe Finance's LendTech TV. I'm Oriel, your moderator for this podcast. Today, we're diving into a topic that's crucial for banks embarking on their digital transformation journey. What are the top lending automation mistakes banks should aim to avoid? Digitalization opens a world of opportunities, but it also comes with its fair share of challenges, and the stakes are high. Joining me today is Richard Hill, Axe Finance's Business Development Director for Europe and an expert in digital lending transformation. Welcome, Richard.
Thanks, Oriel. It's my pleasure to be here. I'm delighted to have this opportunity to discuss with you some of the most common pitfalls associated with lending automation and to offer some suggestions as to what banks can try to do to avoid making them.
Let's jump right in. Digital transformation promises efficiency, compliance, and better customer satisfaction. But the journey isn't always a smooth one. According to McKinsey, 70% of digital transformation projects within banks exceed their budgets, and only 30% fully achieve their strategic goals. Why do you think so many banks struggle with this?
A big part of the struggle comes from underestimating the complexity of digital transformation. Banks often face many issues associated with their extensive legacy IT estate, as well as resistance to change and very fragmented and siloed processes. On top of that, there's the pressure to stay compliant and deliver exceptional customer experience. But when it is done correctly, the rewards can be huge. We're talking about a 20% increase in return on equity and a 30% reduction in cost-to-income ratios. Digital-first banks are even outperforming traditional ones in terms of customer satisfaction, some achieving recommendation rates of over 80%.
Those are impressive numbers. So let's talk about the mistakes banks should avoid. What's the first one on your list?
When a bank has a laser-like focus to deliver an exceptional customer experience, their number one priority must be to avoid creating a complicated and lengthy digital onboarding process. When onboarding new clients is slow and cumbersome, often because of the legacy systems and siloed processes of the bank, customers can lose patience and abandon the journey. Banks need to streamline and simplify this as much as possible by utilising technologies such as digital identity verification, e-signatures, and AI-driven document processing, all of which can help to deliver a fast and positive omni-channel experience.
Absolutely. No one likes a slow onboarding process. Another common issue we see is around risk models. Traditional credit scoring has been a reliable foundation for risk assessment, but there's an opportunity in leveraging AI-driven and innovative scoring models for deeper insights. How can banks strike the right balance between traditional and innovation here?
That's a great question. Traditional models rely on rule-based assessments, which can possibly miss valuable insights. Modernising risk models by using AI-driven scoring and big data analytics can offer a more comprehensive view of borrower risk. Banks can also use alternative data like transaction history and behavioural patterns, but it is crucial to maintain fairness and transparency, ensuring these models remain explainable and compliant.
Speaking of fairness, AI bias is a growing concern. How can banks manage AI bias and ensure their models are transparent and fair?
Banks are allowed to use AI in their lending decisions, but they must comply with strict and continually evolving regulatory governance to ensure fairness, transparency, and consumer protection. AI bias often comes from the use of poorly trained models using unbalanced data sets. Banks must integrate fairness checks and use explainable AI, or XAI as it's now known, to clearly show how their decisions are made. With existing legislation like GDPR in the EU, Consumer Duty in the UK, SR 1117 in the US, as well as the forthcoming AI Act in the EU, the use of AI can be positive, but banks need to ensure continuous audits and diverse training data help minimise bias, thus ensuring equitable and compliant lending decisions.
Let's shift gears a bit. Incomplete credit lifestyle automation is another major pitfall. What's the risk of only automating certain parts of the process?
Partial automation often introduces inefficiencies and operational risks, particularly in commercial lending, where the loan values are significant. Many banks introduce automation for commercial loan approvals, but leave servicing, collateral management and loan monitoring as mostly manual processes. End-to-end platforms like Axe Credit Portal can provide seamless automation across the entire credit lifecycle. Even when different systems are used for other parts of the credit lifecycle process, such as core banking platforms, ACP can connect with them through robust API-driven integrations to provide real-time performance tracking and a much more holistic approach to credit management.
ESG and green lending are hot topics right now. Why is integrating ESG into digital transformation so important?
ESG integration isn't just about regulatory compliance, it's also a growth opportunity. Governments are offering incentives for green financing, and consumers prefer banks that prioritise sustainability. For example, the European Union's Green Deal provides funding opportunities for sustainable projects, and in the Middle East, green bonds are gaining traction. Digital lending solutions with built-in ESG capabilities help banks track sustainability metrics and ensure transparent, auditable processes, enabling them to seize these opportunities while staying compliant.
ESG and green lending are gaining momentum, and there's a lot of potential for banks to lead in this space. It's definitely an area to watch closely. Now, let's move on to personalisation. Personalisation is another area where banks sometimes fall short. How can automation enhance personalised lending?
Advanced digital lending solutions can leverage AI and real-time data to tailor specific loan terms and interest rates that meet the needs of individual borrowers. The use of AI to create a more personalised experience will also improve customer satisfaction and increase conversion rates. If implemented properly, AI-powered cross-selling models can also deliver more tailored product recommendations that better meet a borrower's unique needs.
Now, let's talk about continuous optimization. Staying competitive requires constant improvement. How can banks ensure they're always enhancing their performance?
Real-time analytics and adaptive optimization are essential. By actively monitoring KPIs and refining risk models and consumer experience strategies, banks can quickly address emerging issues and seize opportunities for improvement. It is also important to appreciate that using best-in-class software systems and having access to external consultancy advice can ensure the latest innovations are readily available. This isn't always the case when there's a dependency on old IT systems and manual processes.
Compliance is also one of the major concerns in lending automation. What are the risks of underestimating regulatory complexity?
Continually evolving regulations covering areas such as KYC, AML and GDPR require constant updates. Failure to align your automated workflows with these changes will inevitably lead to hefty fines and reputational damage. A comprehensive digital lending solution like Axe Credit Portal ensures continuous compliance through real-time updates and automated reporting.
Finally, let's talk about legacy systems. How can banks overcome integration challenges?
It is important to acknowledge that although banks are actively trying to reduce their technical debt, their current processes are highly dependent on these old IT systems. Legacy infrastructure can very easily slow down digital transformation. A modular, API-based approach allows new digital lending solutions to integrate seamlessly with existing systems, minimizing disruptions and enhancing data flow. It also removes the massive risk of having to change a core banking platform to support the changing needs of the business.
This has been an incredibly insightful conversation. Thank you, Richard Hill, for sharing your expertise. Before we wrap up, any final advice for banks on their digital transformation journey?
In conclusion, I would say do not underestimate the challenges and complexity of digitally transforming your lending operations, whether they are commercial or retail in nature. Aim to work closely with a partner who has extensive experience in the space of lending automation, as they can help you plan and execute the transformation process so there are no surprises. For 20 years, Axe Finance has successfully deployed Axe Credit Portal in major financial institutions globally. If you stay focused on the big picture, end-to-end automation, AI-driven insights, and continuous optimization, banks can successfully future-proof their lending processes and drive sustainable growth.
Well said. Thank you again, and thank you to all our listeners around the world. Stay tuned for more expert insight content on Axe Finance's LendTech TV. For more information or to reach out to our solution experts, visit axefinance.com. We will always be here to help you make informed decisions to navigate the world of digital lending technology.